Hello and welcome. I'm Solomon. Today I want to share with you publication 537, published 2020, Installment Sales Internal Revenue Service. Here the focus of today's presentation is a foreclosure defense citing fraud is generally a meritless claim if you fail to bring the loan current. That's something you need to understand. The foreclosure defense citing fraud is a meritless claim if you fail to bring the loan current. I want to talk to you a little more about that. This is M. Solomon. We're accountants, auditors. You can reach me at 202-550-8364, and our email is secondarytradedesk@gmail.com. We testify in mortgage foreclosure cases, usually or generally with a certain twist from taxation, punitive taxes, and errors and omissions by the taxpayer as a foreclosing entity. Let's get started. Let's go to the next screen. Here you can see a actual mortgage. Probably seen this one before. There's a reason we keep using it because it's consistent. Here we're going to look at the note. That's the actual note the borrower signed. The servicer's principal balance, outstanding principal balance. Something strange, the servicer also publishes a interest-bearing principal and, of course, a demand for payoff, which was issued right before the foreclosure sale was scheduled. So the note in this case is 586.3. The outstanding principal balance, as shown on the servicing statement, is 618,005.81. The interest-bearing principal is 618,005.81, and the demand for payoff is 881,650.53. When you add those up with the negatives and the positives, you come up with 295,350.53. Let's do the math. The balance of the four line items here is 295,350.53. Subtract the deposit. The borrower deposited 146.6 into escrow when she bought this property. 146.6. That left 148,750 balance. Then the lender came back and said, we're going to adjust the down payment by $25. So her net down payment was 146,575. Folks, these are numbers that they're giving us, not the numbers I've created. So when you subtract these numbers, 146,6, 146,575, and you subtract them from our net balance here, you get 2175.53. What we line item this balance as to zero it out was subsequent payment. Why do we do that? Let's take a look. Under the IRS rules for installment sale, an installment sale is defined as a sale of the property where you the foreclosing party, receive at least one payment after the tax year of the sale. The rest is important, but not really the focus of today's presentation. What is important is that an installment sale is a sale of property where you receive at least one payment after the tax year of the sale. Well, who by golly is making that payment if the loan's in foreclosure? And by sale, they mean the foreclosure sale? Yes. Let's go to the next screen. All right. Once again, installment sale is a sale of property where you receive at least one payment after the tax year of the sale. Mortgage balance, we took the note, outstanding principal, interest-bearing principal, demand for payoff, subtracted the deposit. Always curious as to why they adjusted it, but the down payment actually was a net 146,575, and that left us with 2175.53, where at least one payment is booked after the tax year of the sale. Thank you for joining us. I think if there's anything I want to communicate with you is the importance of the accounting and the importance of the tax considerations. When some have said, attorneys have said, when the IRS gets involved, that's when you really get the lender's attention or the investor's attention. The numbers that we're using were presented to us by the servicer, okay? And of course, this insinuates, or this, the definition of an installment sale, for all intents and purposes, would lay claim to the property having been transferred and that you are being subject to a installment sale method of accounting, not a mortgage method of accounting. If you need to reach me, I'm at area code 202-550-8364, and you can also reach us at secondary trade desk at live.com. Look forward to talking to you.